Price action is one of the most essential yet misunderstood aspects of technical trading, but do you truly understand how it works? If not, you could be missing out on a fundamental tool that could completely shift your trading results. I'll break down the concepts that I use to read price action, and not through smart money concepts, but logic. Instead of diving into flawed candlestick formations and overly complicated market structures, I'll give you some actionable tools which you can apply to your own strategy to increase your win rate. And by the end of this video, you'll be able to spot areas where big money plays its hand using just common sense. Price action, in simple terms, is the movement of price over time, which reflects the collective behavior of the market participants. So basically just a study of the movement of price. And there's many different ways of doing this, such as candlestick formations, market structures, and various trading tools. I'll just be sharing some of the most efficient concepts to understand the market behavior. You'll also need to know what profit taking is, which is essentially when big money cash their positions after a favorable move in their direction, whether it's to reduce risk exposure, to lock in gains, or many other reasons. Let's say you've got all your technical zones for a potential pullback. The first concept we're going to talk about is that if a zone gets breached, the odds of the backup are increased. It's important that you understand the market psychology behind this. If big money are not cashing their positions on one level, they're more likely to cash on the second level. So looking at this, we know price is pushing higher, which means that big money is in profits and they need to cash their positions somewhere. So this is the first area and this is the second area. If they do not cash their positions in the first area, the odds of profit taking on the second area is a lot higher. And it works the same way as if it does make a pullback on the first zone, you do the same thing. You'd want a smash of this zone, then to take the backup zone. And the reason for this is if you're taking a zone where the one before that is breached, already the odds are in your favor. And remember, trading is a game of probabilities. If by applying just one simple rule, every single trade you take has more probabilities and something on top of just tech, you'll automatically have a higher win rate. So when you're considering taking a trade after a breach of the level before, already the odds are in your favor on top of just tech. You have to try think of what is big money doing. If you're a hedge fund manager and you don't cash your positions over here, it'd be stupid not to cash it over here. And you can apply this with even more logic, which I'm not going to go into much in this video, such as end of week, end of session. If a pair has been pushing one way all week and you're coming towards an end of a session and price comes to a technical zone, the odds of a pullback at the end of the week are higher, because if you apply that logic, it's end of session, meaning banks around the world or in that time zone are going to close. They are likely to cash their positions for over the weekend. Let's say you're waiting for a breach of this zone to take this zone. If price does make a pullback from here, yes, you've missed out on a trade. And by applying this logic, you will miss out on some trades, but the ones that you do take have higher odds of success. And I think you're more likely to be profitable if you're trading accuracy-based trading, because you have a higher win rate. Yes, you might have a lower risk to reward, but you have a lot more confidence in your trades. You know they're a lot more likely to work. And if it is even the case that you do miss, you wait for a breach of this one to then take this one. The trades that you are in, you know you've got something on top of tech to back you up. So last week on UJ, I sent out this chart where if there was a breach of this zone, I would then be interested at the bottom of this zone. So this zone over here, the bottom of it is the 61 fib. So the bottom is the 61 fib. And the top is just this 4-hour level over here. If price doesn't make a pullback from this break retest, then the odds of the pullback are higher on the 61 fib. However, if it does make a pullback from the break retest, then I would be interested in the top of the zone. I would only be interested at the bottom of the zone with additional reasoning on top of just tech, such as timing or alignment. But in this case, it had just missed. So if you look at the chart that I sent out, as you can see that if it did make a pullback over here, I would only be interested at the bottom of the zone, so the 61 fib, with additional reasoning. And if it didn't and it breached straight through, then the odds of profit taking are higher from the bottom of the zone, and I'd be happy to take it. So we'll look at this example. So let's say we've got this zone over here and price is coming up and it made no pullback over here, which means it increases the odds of a pullback on this high. So this is simply just key levels. This is a weaker key level. There was no reaction over here. It breached and it made the pullback over here. The one tip that I would give you in terms of profit taking won't give you the big move. It can, but profit taking is essentially just that initial pullback. And the best way to trade this is you cash most of your position at the initial pullback and you leave a runner, because let's say if you cash most of the position over here and you leave a 10% runner, if let's say you had a 30 pip stop loss and 30 pip take profit, at a 1-to-1 you've cashed 90% of your position. If this pair does 300 pips, so even if you had a 50 pip stop loss over here and you cashed at a 1-to-1, if price did come back down here, it would have given you a free counter for the sake of leaving just 10% on the table. And worst case scenario, if price does start pushing higher, you've only lost 10% of the position. So overall, you've still made 80% from this move, but with the potential of making more if price pushed lower. And truly, nobody knows where price is going to go. You're just positioning yourself for the move to potentially occur. The second concept that I'm going to talk about is a very simple yet powerful concept called mean reversion, which is simply that price will go back to its average, the mean. And the best tool to see the average is a moving average. I'm sure most of you use this. And what does a moving average mean? Just an average of the price over a certain period of time. The moving averages I use are the 100 and 200 EMA on the daily time frame. So essentially, when price moves far away from the moving average, either it's overbought or oversold, it's likely to go back to the average. And think of it like a rubber band. The further away it goes, or the more it's stretched, the greater the deviation, the higher the probability of reversion back to the mean. So a pullback towards the moving average again. So imagine price is pushing far away from the moving averages and you've got a bunch of technical zones for a potential buy. Don't be scared to take any of the buys, and especially if you're applying that profit taking logic, if a zone gets breached and you get into this one, you cash and leave a runner. If it does go back to the moving average, then you've got a free runner. If it doesn't, you just keep taking the trades until they do end up delivering. A good way of seeing if something is overbought or oversold is through a indicator called ATR. Now I don't use this indicator, but it is a good indicator if you are struggling to see if something's overbought or oversold. So the ATR, which is the average true range, measures the market's volatility by calculating the average range between the high and the low of the price over a set period of time. So if you go on TradingView and you click indicators and you search up ATR on chart, it should give you like these bands, and if you double click on them, just make sure that the time frame is on the daily time frame, and then you can customize them how you'd like. So if you look at GJ and you look at the ATR, the average true range, which is 415 pips, that's because yen pairs are a lot more volatile than euro pairs. And if you look at euro USD, you can see that that's only 110 pips. Now this doesn't work all the time, but it is a good indicator to see if something is overbought or oversold. So it's towards an extreme end of one side. And even if you do look at it, look here, it worked. I guess this had updated. Here, pretty shit. Here it worked. So it does worked. Here, saw a bit of drawdown, worked. Dismissed, slap this. So it is just something which I don't use, but it could be helpful if you are struggling with finding extreme ends. So the best way to use this would be to add it on top of your technical trading. So you start off with key levels, you plot everything on top of that, and then you put this to see, does it match with any of your technical zones? This is not something to be traded just by itself. It's just to kind of help you with that decision making. Hopefully that was helpful. One thing that I would like to say is that you most likely clicked on this video because you are struggling in trading. The holy grail that you're looking for is not more information, it's journaling. The best way to improve your win rate is to cut out the losses. And how do you cut out the losses? Well, your journal and your data should tell you. You can't go based off memory because our brains as a coping mechanism will push losses under the rug and not remember them. Your data is something which is unbiased and it's the clearest representation of your trading. So if your data tells you you're losing more on Monday, Tuesdays, just stop trading Monday, Tuesdays, and instantly your win rate has increased. And the two concepts that I talked about in this video you can also apply to your own trading strategy, and hopefully that should help increase your win rate.